You are right almost every single time you enter the market. You can accurately predict the trajectory of a chart with a 90% win rate, yet you still completely wipe out your entire portfolio. A brutal mathematical reality is at play. That remaining 10% of trades, the ones you mismanage, carry enough negative leverage to destroy weeks of accumulated progress in a single afternoon. Your technical strategy is likely sound. Your biological response is not. This failure is the result of an evolutionary drive designed for survival, not for the abstract risk of a digital marketplace. Reading market structure requires a cold, analytical mindset. But the moment real money is on the line, you stop acting like a disciplined analyst and react like an adrenaline addict staring down a casino slot machine. Memorizing accumulation and distribution patterns is useless if you operate without an external system to contain your own neurochemistry. Let's trace how this breakdown happens. It begins the second you open your charting software, when your brain triggers a dopamine spike before you have even drawn a single level. Driven by the fear of missing out, you instantly execute a market order. You want the rush of participation, so you abandon your predefined checklist to chase the candle. Your order falls into a liquidity pool, a tight cluster of impulsive sell orders sitting below a major support line. This pool is a primary target for institutional algorithms. They sweep through these clusters to generate the volume needed to fill their massive positions. The true apex predators of this ecosystem are large institutional funds and central banks. While institutions like the Reserve Bank of India don't day trade retail pairs, they release the macroeconomic data and set the interest rates that dictate every significant market trend. Every impulsive retail entry provides the fuel these institutions require to move the market. You are not just risking capital, you are actively manufacturing the liquidity that larger players use to trade against you. We see the ego trap on this line graph. The momentum shifts. A basic corrective wave hits, and your position is pushed into the red. This is where ego overrides discipline. You freeze, hoping the market validates your bias. To avoid the pain of being wrong, you deploy a martingale strategy, stacking heavier positions onto a losing trade. Betting a minor bounce will let you exit at break-even. This approach ignores the fact that markets can trend in one direction far longer than you can stay solvent. You have traded a controlled risk for an uncontrolled death spiral. Accepting a minor logical loss is a professional skill. Refusing to do so guarantees an eventual emotional wipeout. Eventually, the account drain hits the point of maximum psychological pressure. Broken and defeated, you panic and sell at the absolute bottom of the market dip. This is the moment of wealth transfer. As shown here, your capitulation is exactly when professional players step in to buy your liquidated assets at a discount, reclaiming the capital you just surrendered. There is an equally destructive pattern when a position is actually in deep profit. You reach a subconscious psychological threshold known as the wealth ceiling. Terrified of success, you prematurely close winning trades, finding a large positive balance as uncomfortable as a large loss. This human wiring is inherently anti-market. It forces you to be fearless when you are hemorrhaging money and terrified when you are generating it. Since you cannot outsmart your biology, you must remove the human hand from the moment of execution. Implement a 15-minute chart lockout. When you open your software, sit on your hands. This allows your initial adrenaline spike to subside before you make a single decision. Replace market execution with limit orders. By naming your price in advance, you kill the impulsive click-and-pray dopamine hit that leads to overtrading. Place hard stop losses on the broker's server at the moment of entry. This cedes control to the machine, capping your maximum daily loss at 2% without room for negotiation. To bypass your psychological wealth ceiling, change your platform display. Show your profit and loss in percentages or pips rather than raw dollar amounts. These mechanical rules are designed to protect your capital from your own impulses. By externalizing risk management, you can finally move away from emotional gambling and treat your trading as a disciplined business.